Welcome to another episode of Business by the Numbers. I'm your host, Hunt Emrys, CPA with Parmelis and Associates. You work for yourself, so you deserve a big salary, right? Well, did you know that this is one of the most common ways that people are losing money by not paying themselves the correct amount? How much and how you should be paying yourself is exactly what we're going to talk about this week. Before we get into that, I just want to stop and say thank you to you and the rest of the dedicated listeners. Remember, if you want to hear your question answered on here, just have a question for me or an idea for a future episode, shoot me an email at podcast@parmelis.com. And lastly, we cannot forget our dedicated sponsors, NapaTrax and Promotive, for being such loyal supporters of the show. How much should I pay myself, Hunt? All right, I've been asked this a ton. We've talked about this before. I've done episodes on this, but I still get this enough that we got to do a whole episode on it, right? So hopefully you could be able to answer this. And this is a really easy one. I feel most people have it pretty close. Every once in a while, someone gets this really far off. So if you have someone, even if they're not a shop owner, right? Like most of what we're talking about here today is applicable to really any type of small business owners. So as always, please share with your friends if you think someone can use this. So what are we talking about today? How much can we pay ourselves? So what we're really talking about is an S corporation, because in an S corporation, you have two kind of relationships with your business. In one aspect of your business, you're an employee, right? You're on payroll and you have to pay yourself some sort of wage. Also, you are the owner of the business, so whatever profits come your way as well. Now, you're the owner and an employee, so you get to decide how much you want to get paid on payroll. A lot of people just like to increase their payroll as they start making more money. A lot of people don't like to take payroll at all. But what we will find out here in a little bit is the proper amount is somewhere in the middle. Now, we are only talking about S-Corps because if you're a partnership, you don't take payroll. If you're a C corporation, payroll is the only way that you can take money out of there. And if you're an LLC sole proprietor, you're not on payroll as well. But we'll talk a little bit about that sole proprietor S-Corp relationship because what we're talking about this week kind of goes right into what we talk about for switching from a sole proprietor to an S-Corp. So if you're an S-Corp like we talked about, you got two ways to get money out of your business, payroll and distribution. So let's start with payroll here. Whatever you take out in pay lowers your profit, right? Because it is an expense of the business. Now, it does not actually give you a tax break. And I tell people this all the time. And this is very important, especially as we're talking about during tax estimate season or tax planning season, is should I give myself a bonus? Making a bunch of money in my business this year, you know what, hon? I'm going to give myself a bonus of $40,000. So that doesn't save you any money on taxes. Think about that. You're going to pay $40,000, and that's going to be expense for your business, but then that $40,000 is going to be income to you personally. So from an income tax standpoint, those two counteract each other. Now, on the other side of this, you are also paying payroll taxes on those wages. So we know that we do not get any income tax deduction. It's just a wash. But on that $40,000 of wages or bonus that we just paid ourselves, 15% of that is going to go in the form of payroll taxes. So even though it did not help us on income tax, we are actually behind by giving ourselves too much in wages. What is that 15%? Social Security, Medicare, FICA, right? State unemployment, possibly, depending on where you are. But if we're looking at the impacts of giving yourself a $40,000 bonus this year, you're going to save zero money on taxes, and you're probably going to spend around $5,000 or $6,000 on payroll taxes. So don't do it. What happens if you want to take out distributions? Now, the question that we always get on distributions here is, how much tax do I pay on distributions? And the answer is zero. You do not pay tax on distribution. If you go and take a distribution right now of $50,000, $100,000, $1 million, I'm going to almost guarantee you that you are not going to change your tax liability one bit. The reason is you are taxed on income, not necessarily distributions. So let's say that you make $100,000 of net income, right? You take a look at your profit and loss and you look at your net income and it shows $100,000. You are going to pay tax on that $100,000. Doesn't matter if you leave all that money in the business or if you take distributions out of there. So common misconception here is, well, I'm going to leave this money in the business. I won't have to pay tax on it. No, you should not leave all of your profits in the business because you will not have cash to pay your tax bill on that said profits. Now, the nice part about distributions is there's no double taxation like you have on a C corporation. In a C corporation, you make money, and if you take a dividend out, the shareholder has to pay tax again. For an S corporation, if you make $100,000 and you pay your tax bill on it, that $100,000 is free for you to take out. You do not get taxed again. So you might be thinking to yourself here, if I don't get a tax deduction for either of these, and payroll is taxed at 15%, why do I even take payroll at all? Now that your wheels are turning and we have a little bit of the backstory, we're going to get into the nuts and bolts of how much should you be paying yourself. Because I could give you a number here, right? And I'll give it to you right now, probably between $60,000 and $70,000. And you could stop this episode, you could go and you could put that number in there, adjust it, and you could save some money. But I want to give you a little bit more education why, and also some of the intricacies of maybe this number doesn't make sense for you, does, etc. When people look at this equation, I get where you're coming from, right? You say, well, anything I take out on payroll doesn't save me any tax money. I pay payroll tax. Distributions don't have that. I'm just going to take all of my money out in the form of distributions. And I'll say first, you have this partly right? You're hitting the nail on the head from a tax perspective, but there's two reasons that you cannot and should not do this. So the first of which is the IRS says if you're an S corporation, you have to pay a fair and reasonable salary. Period. End of story. What is a fair and reasonable salary? They do not give us guidance on that. Now, if you pay yourself $4,000 a year, would you be able to argue that's a fair and reasonable salary? If you're working full-time, absolutely not. Now, is that something where the IRS comes in and says, you're making $40,000, we think you should be making $80,000? No, I've never seen it. It might happen, but really all of the court cases surrounding fair and reasonable compensation are all people that have gone super aggressive on this. Like they make $400,000, $1 million in profit, and they take zero wages. So we need to be on there. You need to be taking fair and reasonable amount. And really, that's a very subjective number. Never seen a question. Now, the other aspect of this is we are paying into Social Security, Medicare, right? FICA, FUTA, all that stuff. And there is some benefits there. So where we decide to put this around $60,000 or $70,000 is also going to allow us to maximize our benefits of Social Security. So if you do not pay any money into Social Security, you do not get any money from Social Security. It's fairly straightforward. When we are looking at this, why did we pick a $60,000 to $70,000 number? Really, the biggest reason is it checks both of these boxes while still arguing a point that is going to be effective for us, right? Because anytime that you're looking at, tax or accounting, there's a lot of subjectiveness to this and there's a lot of arguments you can have up or down. So generally you're going to pick something that, checks the boxes and also puts you in a good position from a tax standpoint. And this is what we are, talking about right here. $60,000 to $70,000 is enough money that if the IRS ever came in there, it would be very hard for them to argue for a full-time role, of a store manager, a advisor, whatever you want to call yourself. That's enough salary for them to, not bat an eye at. It's probably never going to get looked at. I don't want to say I guarantee you it's never been looked at, but I can say I've never heard of it happening. I've never personally seen it. And also, it's a very legitimate thing. Most places, $60,000 or $70,000 gets you a pretty decent warm body for a year. Now, the other side of this is Social Security. So why did we pick that number as it relates to Social Security? So as you pay into Social Security up to like $140,000, you're going to get more of a benefit down the road. So once you make over that amount, Social Security stops, accruing because you're not going to get any more benefits. The reason why that $60,000 to $70,000 range is a good one for people's earnings is that is the end of the second gate of Social Security. So the way that it works, and it's kind of convoluted because Social Security doesn't really share this stuff as readily as you would like, but let's say that you make $0 to $20,000. For every $1 that you put into Social Security, you might get $2 back. And then on the second gate, for every $1 you put into Social Security, you might get $1 back when you retire. Once you get past that second gate, I believe that there is 4 or 5 of these, you start getting returns like, hey, I put $1 in and I get 75 cents back. I put $1 in and I get 40 cents back at future benefits. So after that $60,000 to $70,000 mark, our return on investments for our Social Security contributions drop down where it no longer makes sense for us to try and contribute to that. To put this in dollars and cents of, well, Hunt, I really was kind of factored on my Social Security benefits. Your Social Security benefits when you retire should be supplemental, right? They were never meant to live off of. And if you pay yourself around 60 to 70 grand on current day's numbers, that works out to be about $2,000 a month payment when you retire. So not bad at all. So before we get into, kind of a little bit of an exercise to just kind of show through how this works and how it would look in real life, and then also maybe some outlier situations might justify a higher compensation amount, I want to talk about paying your spouse because this is something that is very common for small businesses. And I don't really care in this situation if that spouse actually works there or not. So the advice doesn't really change. If you have separate finances and you're married, then don't upset the apple cart, right? Like if your spouse's payroll goes into their spending money, then this is probably not worth any sort of marital strife. Now, if it all goes to the same place and whether you get paid, your spouse get paid doesn't matter, then this advice is for you. As we talked about on Social Security, you pay into your benefits. And what you're allowed to do when you actually collect Social Security is take your benefits or half of your spouse. So let's say that your spouse worked and their benefits are $2,000. You never worked. You are still subject to $1,000 in Social Security. So there is a planning opportunity here for a spouse to not pay into Social Security and still get a good benefit. And now the good news for you as a spouse is, well, what if I get divorced? You're allowed to go and actually pick any of your spouses that you are married to, and you get to pick the highest one. So, you know what? If you're married to someone that's broke now and you got divorced, next person you try, see what their Social Security wage base is, I guess. But argument there for most married people combined finances is don't pay your spouse. It has nothing to do with merit, has nothing to do with value. It's just we're paying them. We know we don't get a tax deduction and we're paying payroll tax. Now, the only caveat here is for benefits, right? If they have to be on there to get benefits for health insurance, if you are doing a 401k or an IRA, some sort of retirement, obviously put them on there to max that kind of stuff out. But if they are just truly getting a paycheck for their value of services, do not do it through payroll, do it through distribution and save some money on payroll taxes. I get the idea, right? But can you talk to me a little bit more about how this works and maybe some real life examples to tell you how much this will save you and why you should care about it? So let's say that you are sitting here thinking to yourself, all right, I make around $130,000 in payroll. How much of an impact does this have or how much can I save? So if we have around $130,000 on payroll, then we are probably paying right around $20,000 in payroll taxes. So if we look at that same exact business and we say, well, we're going to not take $135,000 out on payroll or $130,000 out on payroll, but $65,000 through payroll and $65,000 through distributions, we know that from an income tax standpoint, it's going to be a wash, 6 1/2 dozen. But we just cut our payroll tax bill in half. So instead of spending $20,000 on payroll taxes for $130,000 of wages, we only spent around $10,000 on $65,000 in wages. What we did is we got the same amount of money, or actually we got more money if you factor in the payroll tax savings, just by shifting around how we are paid. Not how much, not when, just strictly instead of doing this through payroll, we're going to do this in distributions, which we are legally allowed to do. Use the laws to your advantage. Now, how does this work in real life if you're looking to make this shift on it? The simplest way that I tell people is, all right, you know what you're making now, right? It's probably too high if you're wanting to make a switch. So you're going to go reduce your payroll down to $70,000 on salary. I wouldn't go crazy and say like, hey, I've already made this much. I would just make it correct going forward. This year, you've already probably paid a little bit too much. It'll work fine going forward. But let's say you go in there, you update your payroll, and now you're annual salary is $70,000, not $130,000. Your net check is going to go from whatever, $2,500 a week to $1,200. That $1,300 difference in take-home pay, all that you're going to do is every time that you take payroll, you're also going to write yourself a distribution check. Code it to draws, distributions, whatever. Or you could even set up as an automated transfer. So every time that your payroll gets direct deposited, so does an automated transfer for the distribution. At the end of the day, like I said, the perfect example here is we are going to end up getting the same amount of money, just shifting around how we're paying that. But behind the scenes, we're actually going to be saving some payroll tax money. Like I said, this is not something that works for everyone. Your results may vary. You should talk to your accountant, confirm this stuff if you're unsure of this, but there are times where having higher compensation works. The first one, and this is not even on my notes, just as I'm going down through this, I thought about this. If you are not good at saving money for taxes, and you are your own worst enemy on this, I see some of my clients taking a bunch of money out on wages just so they know the withholding is paid in. Are you paying too much in payroll tax? Yes. Are you always going to make sure that your tax bill is paid? Yes and yes. So it's not advisable. You're still paying too much in payroll taxes, but if that's the way that you're doing it so that you can, guarantee that this tax money is getting paid, then awesome. That's even better. Now, also, if you have certain retirement plans, like a 401k, and especially a 401k with profit sharing, there's sometimes situations where having a higher than average payroll makes sense. Same thing is if, maybe you're not on as proper ownership amount, you got partners with differing roles, or maybe mom and dad still own it, but you work there. Yeah, there's tons of situations. Not everyone sits in, a cookie cutter, easy, no strings attached. So there might be a reason of why your payroll is higher than it should be. And it's also on the same flip side of this, right? If you're only taking out $30,000 or so in wages, you could have an issue with someone looking at this. If you're older and you can argue that, hey, maybe I don't work full time on there, does a market rate of 30 or 35 grand? Yeah, absolutely. As long as you're aware of the Social Security tax impacts. But if you've are kind of close to Social Security anyways, the less and less this is going to have an impact on it. Keep in mind, Social Security goes from your highest 35 years of earnings. So if you're 60 years old right now, it's going to take a big swing up to change it much. And also on the same flip side, a big swing down, but probably not even possible. This is something, like I said, it could be slightly different for everyone, and it's something that we look at a lot when we're tax planning for our clients. If you're sitting here, though, and taking a lot of money on payroll, you should really reevaluate that and talk to your accountant to see if there is a planning opportunity here. Please share with friends if you have any questions, comments, or ideas for a future episode. Shoot me an email at podcast@partmellis.com. Thanks again for listening on the Aftermarket Radio Network. You can find all shows on aftermarketradionetwork.com and on your favorite podcast listening app. So thanks again for joining me on Business by the Numbers. Stay safe out there, and I will talk to you all next week.